Good evening. It's January 22nd, 2026, and while most people are winding down their Wednesday, I've been staring at something that doesn't make sense. The Western markets closed a few hours ago. Silver on your screen probably showed $93.34. Maybe you saw the sideways action and thought, consolidation. Maybe you heard the whispers about stability. Maybe you even bought into the narrative that this rally is cooling off. Here's what they're not telling you. While New York was closing flat, India's MCX hit a record high of $113.24 per ounce. Let me say that again, $113 in Mumbai. For the same metal that's trading at 93 in New York, that's an $18.24 gap, not a spread, not a minor premium. An $18 canyon between what the West says silver is worth and what the East is willing to pay to actually own it. I've been analyzing commodities, markets, and stacking physical silver for 12 years, and I have never seen a bifurcation this violent happen this fast. There is an invisible wall standing between New York and Mumbai right now, and if that wall doesn't break in the next 48 hours, the Western vaults are going to be hollowed out before most people even realize the game has changed. That's what this video is about. Here's my claim, and I'm going to spend the next several minutes proving it to you with math, not hype. The global silver pricing mechanism has fractured. This isn't a spike. This isn't a geopolitical blip. This is what I'm calling the Great Fracture, where the West's ability to control prices through paper contracts is being incinerated by physical demand in the East. China has restricted silver exports. India is paying a 20% premium over New York. And the COMEX, the exchange that's supposed to be the backbone of Western price discovery, just lost 26% of its registered inventory in the second week of January alone. Let me be clear about what I'm going to show you in this breakdown. First, I'm going to teach you the mechanism behind what's happening. It's called geographical arbitrage, and once you understand how it works, you'll see why $93 is a fake price. Second, I'm going to walk through the math on that 26% inventory drain and show you what happens if this pace continues for just 2 more weeks. Third, I'm going to share the 3 specific triggers I'm personally watching that will dictate my next moves as this storm makes landfall. And here's the kicker. To understand why we're at this moment right now, you first have to understand the trap the bullion banks just walked into without realizing it. Let me teach you something that Wall Street doesn't want retail investors to understand. It's called geographical arbitrage. In academic terms, it's also known as market bifurcation. But let's skip the jargon and get to what it actually means. Geographical arbitrage happens when the same asset is being sold for 2 wildly different prices in different parts of the world. It's a signal that the market is no longer a single unified global system. It's 2 separate systems that have stopped talking to each other. Think of it like this. Imagine you're trying to get into a sold-out concert. Outside the stadium, scalpers are selling IOU tickets for $95. They're promises, paper receipts that say you'll get a seat eventually. But at the actual turnstile, at the door, the venue is at maximum capacity. People are desperate to get inside. So the door price, the price for an actual physical ticket that gets you through the gate right now, is $113. That's what's happening in silver. The COMEX in New York represents the IOU ticket. It's paper. It's a promise of future delivery. Most of the time, traders settle in cash. They never actually take the metal. They just speculate on the price movement. India and China represent the door price. They want the physical metal. They need it now, and they're willing to pay a massive premium to get it. Here's where the trap springs. Professional arbitrageurs, the big institutional traders, are now doing the most obvious trade in the world. They're buying the cheap paper silver in New York at $95. They're standing for delivery, demanding the actual bars. Then they're shipping those bars to India and selling them for $113. $18.24 profit per ounce, risk-free, as long as the COMEX has metal to deliver. And that's the problem. This process drains the physical silver out of the West. Every time a trader stands for delivery, the COMEX has to pull metal out of its registered vaults and hand it over. The more this happens, the emptier the vaults become. Once the West runs out of metal to ship, one of 2 things has to happen. Either the paper price in New York skyrockets to match India's $113, eliminating the arbitrage opportunity. Or the Western exchanges simply fail to deliver. They default. They declare force majeure. They admit they sold more silver on paper than they actually have in the vault. And based on the data I was looking at this morning, that empty vault scenario isn't a theory anymore. It's a mathematical certainty that's playing out in real time. Let me paint the picture of where we are right now. As of 8:30 this morning, Eastern Time, spot silver was trading at $93.34 globally. Gold, for context, is sitting at a staggering $4,832.11. But here's where it gets interesting. The COMEX, the paper price in New York, is around $95. Meanwhile, India's MCX, where they're trading physical metal, hit $113.24. That's the divergence I mentioned, $18.24. Now, let me show you what's happening behind the scenes. COMEX registered silver inventories, the metal that's actually available for delivery, dropped by 26% in just the second week of January. Not over a quarter, not over 6 months, 1 week, 26% gone. And it's not just small retail traders taking delivery. Institutional players, the big funds, are no longer accepting cash settlements. They want the bars, they're flying people to the vaults to verify serial numbers, they're chartering cargo planes to move metal across the Pacific. This is not normal behavior. This is the behavior of a market that no longer trusts the paper. And then there's China. China has moved to protect its own domestic supply by restricting silver exports. Only massive pre-approved firms can ship metal out of the country now. The Silver Silk Road, the flow of metal from east to west that used to stabilize these price gaps, has been cut off. Let me show you what this looks like visually in your head. Imagine a graphic of that $18.24 premium. In a normal, functioning market, the premium between physical and paper is measured in cents, maybe $1 or $2 if there's a logistics bottleneck. $18 is not a gap, it's a canyon. It's a market screaming that something is fundamentally broken. The skeptics will tell you this is just a geopolitical bubble. They'll point to the Greenland rumors and say the market is about to collapse. But their solution has one fatal flaw, and I'm going to show you why in a second. Let me address the elephant in the room. There's a rumor circulating right now that the United States and NATO have secured a secret deal for massive mineral rights in Greenland. The theory goes that this will flood the market with silver and the shortage and pop the $113 bubble in India. On the surface, it sounds plausible. More supply equals lower prices, right? Wrong. This is what I call a supply illusion, and it's based on a fundamental misunderstanding of how mining actually works. Even if a mountain of silver was discovered in Greenland this morning, it would take a decade to build the mine. You need permits, environmental reviews, infrastructure, roads, power, refining facilities. Then you need to actually dig the ore out of the ground, crush it, refine it, and turn it into deliverable bars. That process doesn't happen in weeks. It doesn't happen in months. It takes years, sometimes decades. The physical metal that India needs to satisfy its $113 demand is needed now, not in 2036, now. So the Greenland rumor, even if it's true, is completely irrelevant to the current supply crisis. It's a distraction. It's a narrative designed to make you think the shortage is about to end so you don't panic. Here's another myth I keep seeing. People are pointing to the Shanghai margin hikes that went into effect today, January 22nd, as evidence that the market is weak. They're saying, look, the Chinese exchange is tightening requirements. That means they think prices are going to fall. That's not what a margin hike means. When an exchange hikes margins, it's because volatility is so extreme they're afraid of a systemic collapse. They're saying, we need more collateral from traders because the swings are so violent that we can't guarantee settlement anymore. It's a sign of strength, not weakness. It's a sign that the move is so powerful, so unstoppable, that the exchange itself is terrified of what happens next. So while the skeptics are waiting for Greenland silver that doesn't exist yet, the math of the current vaults is telling a much darker story. And that's where we need to go next. Let me walk you through two scenarios. One conservative, one stress test, both terrifying. Conservative scenario. If the COMEX continues to lose 26% of its registered inventory every 2 weeks, the math is simple. At that pace, the registered category, the silver that's actually available for immediate delivery, hits absolute zero by the end of February. Not low, not critically low, zero. Now, I don't think it gets to absolute zero because long before that happens, the exchange will declare force majeure or halt deliveries or change the rules. But the point is, we are weeks away from a moment where the COMEX can no longer function as a physical delivery market. And once that happens, the paper price becomes meaningless. Because what good is a contract that promises you silver if there's no silver left to deliver? Stress test scenario. If the India premium hits $20, the incentive to drain the West becomes so profitable that every major bullion bank becomes a target for a physical run. Think about it. At a $20 premium, you can buy silver in New York, demand delivery, ship it to India, and pocket $20 per ounce. If you're moving 10,000 ounces, that's $200,000 profit on a single shipment. That kind of arbitrage doesn't go unnoticed. It attracts capital, it attracts institutional money, and it accelerates the drain exponentially. Now let's zoom out and look at the bigger picture. Gold is currently trading at $4,832.11. Historically, the silver to gold ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has averaged somewhere between 50 and 70. Right now, at $93 for silver, that ratio is around 52. not crazy, but if you believe gold is correctly priced at 4,800 and you believe the historical ratio should hold, then silver shouldn't just be at 113. It should be approaching 150. Let me recap where we are so you can see the full picture. We know the India premium is $18.24. We know COMEX inventories dropped 26% in 1 week. We know China has locked its export doors. And we know the paper price in New York is being held together by a thread of trust that's fraying faster than anyone wants to admit. The global paper price is a lie. And the only reason it hasn't exploded yet is because the banks are hoping this blows over before anyone notices the vaults are empty. But the real explosion happens when they're forced to admit they're out of metal. And that moment is closer than most people think. Let me tell you what I'm watching right now. First, I'm watching for force majeure declarations. A force majeure is a legal clause that allows a party to break a contract due to unforeseen circumstances beyond their control. In commodities markets, it's the nuclear option. It's what a bullion bank declares when they can't deliver the metal they promised. There are rumors, and I want to be clear, these are unverified rumors, that a major bullion bank is preparing to default on February silver deliveries. If that rumor becomes a fact, if a bank actually declares they can't deliver, the paper price will gap up $10 in a single Sunday night futures opening, maybe more. Second, I'm watching the SHFE price limits in Shanghai. They were widened today. That means the exchange is bracing for a move so large, so violent, that they had to expand the guardrails to prevent a trading halt. When an exchange widens price limits, it's not because they think the market is calming down. It's because they think the market is about to rip in one direction so hard that normal limits won't contain it. I'm watching the $105 level in Shanghai specifically. If that breaks, the next leg up isn't inevitable anymore. It's happening right now in real time. And third, I'm watching the India premium. If it stays above $15 for the next 48 hours, that tells me the physical run is permanent. It's not a temporary dislocation. It's the new normal. If the premium hits $20, I'm personally going to stop looking at paper charts entirely. At that point, the only thing that matters is how many physical ounces you can get your hands on before the window closes. So how am I personally playing a market where the prices on the screen don't match the bars in the vault? Let me be very clear about something. I'm not giving you advice. I can't tell you what to do with your money. But I can tell you what I'm doing with mine, and you can make your own decisions from there. I believe we are witnessing the death of price discovery in the West. The London and New York exchanges, the markets that have set global silver prices for decades, have lost their authority. The East has taken over. Mumbai and Shanghai are the new leads. And I'm not looking at the $93 price as a point of exit. I'm not even looking at it as a target. I'm looking at it as noise. What I'm watching is the India premium. Here's my personal if-then plan. If the premium stays above $15 for the next 48 hours, I'm concluding that the physical run is permanent, that the arbitrage trade has become structural, that the West is being drained and there's no stopping it. If the premium hits $20, I'm done looking at paper charts. At that point, the only question that matters is ounce count. How many ounces do I own? How many can I acquire? Where are they stored? Can I verify them? And if silver dips to the $91 support level in the paper markets, I'm viewing that as a gift. I'm viewing it as an opportunity to acquire more metal at a fake price before the market forces it to the real one. Because here's what I know from 12 years in this space. The bridge between the paper world and the physical world is burning. The two prices can't coexist forever. Eventually, one has to break. And when it does, the paper price either skyrockets to match the physical, or the paper market collapses entirely. I know which side of that bridge I want to be on when it falls. If you've been following this channel, you know I've covered market squeezes before. The most famous one was the Hunt brothers in 1980. Two billionaire brothers tried to corner the silver market by buying up physical metal and futures contracts. They drove the price from $6 to $50 in a matter of months. Then the COMEX changed the rules. They banned new futures purchases. They forced liquidation. The price collapsed. The Hunt brothers went bankrupt. But here's the difference between then and now. The Hunt brothers were speculating. They were trying to manipulate the market. They were vulnerable to rule changes because they were using leverage. What's happening now isn't speculation. It's not manipulation. It's a genuine physical supply crisis driven by sovereign nations and institutional demand that can't be ignored. China isn't going to stop restricting exports because the COMEX asks nicely. India isn't going to stop buying physical metal because Wall Street is uncomfortable with the premium. This isn't the Hunt brothers. This is a geopolitical realignment of the entire commodities market. And the West doesn't have the leverage to stop it. The parallels are terrifying, but the outcome is going to be different. Because this time, the shorts can't just change the rules and walk away. This time, the physical metal has to be delivered or the system breaks. And I think the system is about to break. Let me tie this all together for you. The $18 premium in India is the smoking gun. The 26% inventory drain in 1 week is the motive. The China export ban is the weapon. The sideways consolidation you saw in New York today isn't calm, it's paralysis. It's a market frozen in disbelief, waiting to see who blinks first. But the math doesn't care about disbelief. The math says the COMEX is running out of silver. The math says the arbitrage trade is accelerating. The math says the paper price is disconnected from reality. And the math says this calm is a temporary illusion that ends the moment the vaults are proven empty. Here's my forecast. The storm arrives when the West runs out of silver to ship to the East. That could be 2 weeks from now. It could be 4 weeks. But it's not months. It's not next year. It's soon. And when it happens, $113 won't be the ceiling. It will be the floor. Because once the West admits it can't deliver, the entire pricing mechanism collapses. And the only price that matters is what someone is willing to pay for physical metal they can hold in their hand. That's the fracture. That's the great bifurcation. That's the moment we're living through right now, whether the mainstream media wants to acknowledge it or not. The next leg up isn't coming. It's already here. You just can't see it yet because you're looking at the wrong price. If you want to understand how a force majeure default actually plays out in the history books, I did a deep dive on the Hunt Brothers squeeze that walks through the mechanics step by step. The parallels to what's happening right now are disturbing, and I think you'll find it useful as a reference point for what to expect in the next few weeks. You'll find that video linked in the description. And if this breakdown was valuable to you, if you're part of that rare group who actually wants to understand the mechanism instead of just chasing headlines, do me a favor and share this with someone who needs to see it. Because the mainstream media isn't covering the story. They're too busy talking about Greenland deals that won't matter for a decade. The fracture is here. The vaults are draining, and the bridge between paper and physical is burning. You have to decide which side you want to be on before it collapses. I'll see you in the next one.